The September effect usually results in a red market, but this year may be the exception to the rule. Hold on to your seatbelts, folks. This is going to be a good one. September has traditionally been a bad month for stocks, and it goes without saying that most people have very low expectations going into the month. In fact, on the TSX in the last 10 years, we have had 4 green Septembers, so there could be something to that September effect. The challenge portfolio is looking much better thanks to, well, that green September. However, before we look at why Septembers tend to be bear territory, let's quickly look at an overview of where we are in the 0 to 100K TFSA challenge. We have just completed month 15. And thus far, a total of $8,036 has been added to the challenge. For those of you brand new to this series, we add a minimum of $500 each month, and we top it off with any super chats, thanks, or stickers that are made on the channel. Thus far, viewers have added a total of $505. A huge thank you for your support. September is historically known for being a challenging month for stock markets, and this is often referred to as the September effect.
But why does this happen?
That is a great question. And honestly, there is not a definitive answer, but there are factors at play that do help the bears gain a footing in September. One of these factors is the seasonal trading patterns that emerge after the summer months. Many institutional investors, well, they're returning from vacation in September and will often then reassess their portfolios. This can lead to rebalancing and selling off of assets after those summer rallies. Other factors include tax loss harvesting, where some investors will begin to start selling those underperforming stocks ahead of year end to offset, of course, capital gains, further adding to that downward pressure. Also, some corporations pay taxes on a quarterly schedule, with one of those payments falling right in the middle of September, so there could be some liquidations of their assets to make that payment. The post-summer economic slowdown, with weaker consumer spending and corporate earnings expectations, also can play a role in reduced market confidence. Lastly, the psychological influence of the September effect may become a self-fulfilling prophecy, as investors expect the market to underperform based on those historical trends, which then leads to more cautious behavior. These combined factors contribute to September's reputation as a risky month in the markets. This year, September started very red, but recovered, and the portfolio certainly benefited from some of the early buy the dip opportunities. Whether we have a red or a green market, a sub to the channel is always appreciated big time. Let's get into the challenge portfolio. We will start with the stocks that we have not added to in this cycle. We will start with Bell. So BCE does have a total return of 2.75%. We've got Scotiabank BNS at 24.52%. Holy banana bread. Scotiabank has been on a tear since the middle of August. Up next, we have a purpose Bitcoin spot ETF, BTCC.B. They are up 10.35%. We have C&Q. They're down 6.27%. No worries, though. This one will bounce back for sure. We have CNR at 3.51%. And oh boy, we got divisive dividend, negative 23.26% total return. They continue to disappoint me. Moving on to more friendly skies, we've got Canoe up 21.80%. A really great performance for sure. Unfortunately, though, they have lost the GOAT award this time around, as Scotiabank beat them. But is that enough for Scotiabank to take the title this month? We're going to find out in a bit. We have Fortis with a 15.27% total return, another great example of a company benefiting big time from those rate cuts. Pizza coming in a little on the low side, negative 1.18%. We have QQCL with negative 1.55%. We have RMAX at 11.66%. And now for our US stocks, we have AIQ, so that's the Global X FDS AI ETF, starting to rebound 6.27%. We have Friedman Industries at negative 12.08%, and Liberty Energy negative 18.07%. Let's switch gears and look at the stocks we have added to this time around. We will begin with Air Canada, and we added another 5 shares to bring our total up to 10. and a 1.93% stake in my portfolio. Their adjusted cost base coming in at $14.97, and they're currently priced at $16.52. They don't have any dividends, so the return on investment, total return, both the same number, 10.53%. So this one is a longer-term swing trade. Any month Air Canada drops below $16, I'll be adding another 5 shares. Then, probably in 2025, if they break above $20, I will be exiting this position. We'll see the end of the swing. Next, we have Brookfield Asset Management, and we added another share to bring our total up to 10 for a 7.46% stake in our portfolio. The adjusted cost base, $52.05. They're currently priced at $63.81. So far, dividend-wise, we've received $14.95. So we did get another $4.68 this month. That return on investment, that's coming in at 22.59%. Factor in the dividends. Total return, wow, this is a lovely one, 25.47%. Brookfield had a great month. I don't think I can love this stock any more than I do. Next, we have Bird Construction, and we added another share to bring our total up to 5 for a 1.39% stake in the portfolio. Their adjusted cost base comes in at $20 even. I love an even number. Their current price coming in at $23.75. We did, of course, receive another 19 cents in dividends, bringing that total up to 75 cents. Return on investment, 18.75%. Add in the dividends, 19.50%. Bird Construction is still hanging around the top of my portfolio, and I really do like this company a lot. Our next stock is Diversified Dividend Corporation, and I added 2 more shares, taking us up to 82 in total, and a 2.86% stake in the portfolio. Their adjusted cost base still sitting at $2.76. Their current price sitting at $2.98. We did receive another $1.68 in dividends, bringing that total up to $7.31. Return on investment, 7.97%. Total return after we added the dividends, 11.20%. Next, we have ADP or Drax Group, and I added 3 more shares, taking us up to 20 in total for a 2.60% stake. Their adjusted cost base sitting at $14.36. Current price, it's a little low, $11.11. We have yet to receive a dividend for this one. Their return on investment and their total return, both of them sitting at a dismal 22.63% in the negative. Yikes. They are continuing to struggle. I still do have faith in them, but they sure know how to make me grimace. Next, we have Hammond Manufacturing, and I added 5 more for 35 in total and a 3.58% stake in my portfolio. Their adjusted cost base sitting at $8.89. Current price, $8.75. So far, we have received $1.65 in dividends. So their return on investment, negative 1.57%. Factor in the dividends, total return, negative 1.04%. I still have faith in the Hammond companies, and I will continue to add if they stay low. This one, for me, it's a long-term play for sure. We added 5 more shares to RioCan for a total of 20 shares and a 4.78% stake. Their adjusted cost base sitting at $17.83. Current price, look at this, $20.46. We did receive another $1.38 in dividends, bringing that total up to $8.67. Return on investment, 14.75%. Add in the dividends, total return, not bad, 17.18%. Right now, what can I say? You have got to love REITs. Up next is Sir Royalty, and we added 1 more share for a total of 32, and that's a 4.73% stake in my portfolio. Their adjusted cost base, $14.97. Current price, it's a little bit, it's a lot lower, $12.64. We did receive another $2.95 in dividends, bringing that total up to $24.24. Their return on investment, negative 15.56%. Add in, though, all of those dividends, we do get a total return of negative 10.50%. They did rise a bit this month, and I do expect to see more of that as we move deeper into rate cut season. Next, we have Timber Creek Financial, and I added 5 more shares for a total of 30 and a 2.85% stake in the portfolio. Their adjusted cost base, $7.42. Current price, $8.14. Dividend-wise, we did receive another $1.45, bringing that total up to $7.55. The return on investment, not bad, 9.70%. Add in the dividends, and we get a total return of 13.10%. Next, we have the iShares S&P TSX Capped Energy Index. I added 5 more shares for a total of 25. That makes it a 4.86% stake in my portfolio. Their adjusted cost base, $18.11. Current price, $16.80. We did receive $2.18 in dividends this month. That brings their total up to $4.88. So their return on investment, negative 7.23%. Total return after we add in the dividends, negative 6.16%. This will be a very nice ETF once energy prices rebound. Finally, we added 2 more shares to the Purpose NVIDIA Yield ETF for a total of 10 shares and a 4.30% stake in the portfolio. We averaged down that adjusted cost base to $36.18. Their current price, $37.16. We also received another $6 in dividends, bringing that up to $9.50. Their return on investment, that comes in at 2.71%. Add in the dividends, our total return, 5.33%. I was able to buy the dip. And with a small recovery for NVIDIA, this one is back in the green. I did also add 1 more share to cash.to for a total of 3 shares, and setting my cash position at 1.74%. Now, when it comes to new stocks, this month around, I only added 1 new stock to the challenge. I opened a position in TransAlta with an initial 5 shares. Since I opened that position, they've already risen, get this, 18.54%, as this is, well, it's another utility company that is benefiting from rate cuts big time. Let's take a quick look at the overall portfolio. September was a very interesting month on the market with a huge buy the dip opportunity early in the month. I did get a few deals for sure. Number-wise, the Challenge TFSA came in with a total return of 6.30%. That's up 1.25% from the previous month. So that's not too shabby. We did receive $32.20 in dividends for September for a grand total of $249.34 over the life of the challenge. Let's take a quick look at the portfolio's diversification with data pulled from the Blossom app. According to Blossom, our top 5 represented sectors are financials at 30.1%. I am blaming Scotiabank for pumping this sector up. I will certainly not be buying any more financial stocks until this number comes down. I'd like to see this a little bit lower for sure. We also have industrials coming in at 26.1%, energy at 13.9%, consumer cyclical at 9.8%, and communications at 7.0%. Hopefully by next month as well. Communications will get knocked off the list as real estate. I'm still pumping that up. It's not that far below. It is time to look at the toad and the goat of the portfolio for the last month. The infamous Toad Award for our worst performer of the month is once again going to, no shocker here, Decisive Dividend Corporation with a negative 23.26% total return. In second place is ADP Group with a dismal negative 22.63%. I really have higher expectations for ADP. Let's see what happens next. And now for the GOAT. And we have a brand new winner, and it is Brookfield Asset Management with a total return of 25.47%. That is just fantastic. Our runner-up is Scotiabank with a total return of 24.52%. Poor old Canoe, they fell to third place with their not too shabby 21.80%. It has never been a tighter race for the GOAT, so I'm excited to see who wins next time. Now, I do have some news on the challenge. So our very next 0 to 100K challenge, we're not going to see that until the first week of January, as we are switching to a quarterly update format. No worries. We will still give a monthly update on the community tab. And you can also see what's going on, of course, with Blossom, link down below once again. If you are interested in any of the stocks we looked at today, don't forget to put in a whole heaping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on rate cut friendly sectors. Thank you for watching, and I will see you in the next video.